Charles Biderman, you launched the first float shrink ETF, the TTFS, in 2011. You stopped sub-advising on that back in June. Now you're back with a brand new float shrink ETF. This is the TTAC. So tell me why you're back in the business.
Well, we were fired by AdvisorShares at the end of June. They gave the fund to Wilshire. Wilshire changed the name to the Buyback Fund. They've changed the whole methodology. I don't know what they're doing, but we wanted to relaunch the same TTFS, except it's now called TTAC because the Wilshire Buyback Fund gave up the name, but they kept the ticker symbol. So we had a separately managed account from July 1 when we no longer were managing through when we launched yesterday, TTAC. And so the same stocks that would have been in TTFS are now in TTAC, and it's totally different from Wilshire Buyback, and they're charging 90 basis points, 0.9, and we're charging 59 basis points as a management fee.
Well, your performance with the TTFS was extraordinary. Certainly beat the index over the past 5 years, beat the S&P. So talk about your performance, your expectations going forward with the TTAC.
Well, we're the only fund that we're aware of that concentrates on free cash flow. Everybody thinks we're a buyback fund because it's float shrink. But it's float shrink only from companies that are growing free cash flow. We will not invest in a company that's borrowing money to buy back shares. It has to be a portion of their free cash flow, and we will also not invest in companies that are increasing their debt as a percentage of total assets.
Why is this such an effective way to invest, in your opinion?
Well, consider that if a company is reducing its share count by 5% because it grew cash by 10%, that if the value of the company should not go down because there's 5% fewer shares, the value of the remaining shares should go up because the company is actually done well. It's added to cash, but it has less shares. So mathematically speaking, the value of the remaining shares should go up, and that's what's been driving the whole buyback thing. But companies that are borrowing to do buybacks don't outperform.
Are more companies shrinking their floats nowadays?
Well, there's actually less. So this year and recently has been the least amount of new buyback announcements. So companies aren't doing as well. Free cash flow is not growing overall. But we think that our strategy, historically, during bad times, you want to be in companies growing cash. I mean, it's the safest investment, and historically, companies growing cash on a yearly basis have outperformed the rest of the market. It's common sense.
All right. Well, good luck with the brand new /old ETF, Charles Biderman.
Thank you very much.
And thank you for watching The Street.